Hi, my name is Blythe and I'm the Deputy Fund Manager for Aberdeen Property Income Trust. The trust structure continues with our significant weighting towards the industrial sector at just over 53%. During the course of the quarter, we've actually acquired a development site for us to fund the construction of an industrial unit, which will increase that weighting further, and I'll talk about that in just a second. In terms of other sectors, we are continuing with a weighting of approximately 20% to the office sector. This is a reduction following the sales that we made in Q4 of those two offices in Kidlington, one in Kidlington, one in Epsom. We can imagine that we will be probably looking to make further sales in that sector. One change from Q4 is an increase in our retail weighting. We acquired a property, a supermarket in Welwyn Garden City, which has increased that weighting across the quarter. And I'll touch on that investment in due course. But we remain heavily invested in the industrial sector, which we think is going to be accretive to performance given the fundamentals of that sector, despite obviously that significant repricing that we saw in Q4. Following the significant valuation movements that we saw across 2022, in particular the Q4, where in October and November in particular we saw unprecedented valuation declines, monthly moves that were larger than we'd ever seen since MSCI started recording the property movements, and larger than anything that had been seen in the GFC. During Q1 we've seen a slowing of these valuation declines, and we're largely anticipating a marginally negative NAV movement across Q1. As mentioned earlier, we've acquired a couple of assets during Q1, which I'll take in turn. The first was we acquired a site in Knowsley, an industrial site which we have cleared, and we've started construction on an industrial warehouse, 107,000 square foot unit that we'll be building out over the course of this year, and we anticipate completion in December or January, December this year or early January next year. So in terms of changes in the sector, whilst we've only bought the site at this stage, we anticipate that as construction continues, that will increase the weighting that we have to industrial, which we think is a positive. It's a really exciting opportunity that we've got there. We are going to be delivering a building into a relatively supply constrained market, and there remains good occupier interest in that area, and we've already seen some increases in our estimated rental value just during the period since we contracted to buy the site. The second purchase that we made in March was of a Morrisons supermarket in Welwyn Garden City. Again, it's a really interesting purchase. It's where we feel we have perhaps an edge on other investors, and that we are able to take advantage of buying when perhaps others are selling. And then we felt there was a dislocation in terms of pricing for this asset. So we acquired the supermarket. It's a sale and lease back from Morrisons. It's a 25-year lease that we've got, unbroken 25-year lease with CPI index linked rent reviews, with the first 5 years being annual increases. So effectively the rent will increase by CPI, albeit with caps and collars, in the first 5 years annually, and then thereafter 5 yearly. And it's a very attractive yield. We acquired that for 6.35% initial yield, which very, very attractive, and it just effectively shows that there's some dislocation in pricing happening at the moment in the market, and we've been able to take advantage of that for this asset. It's the fundamentals of the building as well. It's not just the lease that we've looked to acquire there, but the asset itself is the only supermarket in Welwyn Garden City with a surface car park and its own petrol filling station. So very attractive, very good trader for Morrisons. But there'd be a number of other operators keen to take that unit if it ever became available. So I've chosen to speak about one of our office assets. Obviously spoken at length about the fact that we're looking to decrease our office portfolio where we can due to sort of concerns around that sector. But what I wanted to touch on was just how our strategy around our existing portfolio is really bearing fruit. So I want to speak about 54 Hagley Road in Birmingham, which is a building that we acquired, and we've put in place, as we do with all of our purchases, a business plan, an asset plan as to what we were planning to do with the building. And one of the things we noticed was that there was the potential to offer quite a lot more facilities and amenities for occupiers of the building. And we think that's really, really key for particularly for office assets, is being able to offer the best experience for staff. What that we feel that does is that it encourages employers to want to take space in these buildings, because it encourages their staff to come to work, which is obviously a real challenge post-COVID. So this property, we undertook a refurbishment of the reception area. We installed a lovely restaurant and some soft seating and cafeteria area, great for informal meetings. We put in some communal meeting rooms, including an auditorium, which we offer for the tenants to make use of as they wish. So, for instance, they might have presentations in there, or they sometimes run yoga or Pilates classes. We've also encouraged our tenants to come forward with any local charities that they're aware of that could benefit from making use of these facilities, and it's trying to integrate the building within the wider community as well, which is something that we think is very, very important. Rather than just being purely an asset that's very functional, we're trying to give it that wider perspective within the local community. We also included changing facilities, bike storage. The changing facilities are excellent for those wanting to take exercise at lunchtime. The bike facilities are trying to encourage that more active lifestyle. And also we're in the process of putting in place some electric vehicle charging points within the car park as well. So trying to encourage that sustainability. So it's very exciting, and what the real positive from that is that we're seeing a material impact of that by an increased level of occupancy. And we have just recently exchanged an agreement for lease for an occupier to take about just over 20,000 square feet of the building. So showing that those efforts and that expenditure is being rewarded with us being able to capture occupiers that might not have come to the building otherwise. So really exciting. It's a really positive story, and it just backs up what our excellent asset management team are doing in terms of trying to ensure that the assets all meet as many of the requirements that current occupiers are looking for in their buildings. The key focus for us on the Aberdeen Property Income Trust will be to maintain our focus on doing the fundamentals right and ensuring that the asset management is capturing all of the opportunities that exist within the portfolio. So, for instance, talking about that letting in Hagley Road, that's a significant letting for us, and being able to drive that vacancy rate down, increase our occupancy will be a real driver of income for the trust. There's a sort of double whammy, really, I suppose, of letting up a vacant space, and that you not only reduce your void costs, the costs that the trust incurs, but you also start receiving income from tenants. So it really makes a huge difference. So really focusing on occupancy and getting down those void spaces is going to be a key focus. Also, it's looking and making sure that we are taking advantage of any changes in the market, any opportunities that we can see. For instance, the supermarket that we acquired in Welwyn, we feel there's a real dislocation there in pricing. We're being able to buy a 25-year lease of a really strong trading supermarket store in a good London commuter town for 6.35% is a really, really good investment for us, and will perform well. That's a significant change from where that pricing would have been 12-18 months ago on that asset. So being able to be nimble in terms of our investments and take advantage of opportunities as they arise will be a real key focus for us as well. And that, we think, all of those elements together, doing the fundamentals on the existing portfolio well, and then making sure we acquire good assets in good areas of the market will be real drivers of performance going forward.